Hey guys, welcome to this beginner's price action course. In this first lesson, we're going to first build a solid foundation of trading knowledge so you'll know what to expect from trading, and moreover, what's expected of you in order to be a successful trader. Okay, and moreover, we're going to cover what price action trading is at its core, starting from the basic philosophy. Okay, so let's get going, guys. Okay, so the first thing you want to remember in terms of trading is that the main goal in trading is to make money consistently and over the long term. So take this graph right here. Now on the vertical axis is total profit. So that's profits minus losses. And on the horizontal axis right here is age. So that's from age 25 all the way to age 35. So that's a 10-year span. Now first let's examine this upper trend right here. So let's say a trader started trading at age 25, and this trader consistently increased their total profit all the way up to age 27, then had a slight drawdown in total profit, but eventually picked back up and again consistently increased their total profit all the way to age 30, and then continued that all the way to age 27 with a slight drawdown right here. And again, consistently increase their total profit all the way to age 35. So this upper trend is a graphical representation of a trader that made money consistently and over the long term. Okay, so in this case, that would be a 10-year span. And now let's look at this bottom trend. So let's say a trader began trading at age 25 and immediately explosively increased their total profit. However, from the age 26 on, all the way down to age 31, this trader did not increase their total profit consistently, and moreover gave back about 3/4 of what he made in his first year of trading. Okay, and then moreover, all the way to age 34, he began to make consistent increases in total profit. However, by the age of 35, his total profit was right where he began 10 years earlier. Okay, so this bottom trend is a graphical representation of what we don't want as a trader. However, that said, this bottom graph, in my opinion, represents the majority of traders' actual situation that they're in. Okay, so you always want to keep this in the back of your mind, that the main goal in trading is to make money consistently and over the long term. All right, now the question becomes, how do I achieve this main goal in trading? Well, in my opinion, much of it revolves around a trading strategy. So if a trader can create a trading method that can make money consistently and over the long term, well, this ideal upper trend right here becomes possible. All right, so let's first look at what a trading method is. Okay, the basic construct of a trading method. So at the core of a trading method is the method of analysis. So this is how you analyze price in order to know when to buy or sell. Okay, and the major schools of thought when it comes to methods of analysis is fundamental analysis, technical analysis, and price action analysis. Now let me briefly explain to you the type of analysis each of these are, in my opinion. All right, so this is a dollar CAD monthly chart. Now, the basic philosophy of fundamental analysis, in my opinion, states that there are times when current price is not at the true value of a currency pair or an asset. So in other words, although current price is at this price level right here, a fundamental analyst may view that this currency pair's true value or true market price is at lower levels, let's say at this level right here. So in this case, since price is above the true market value, a fundamental analyst will sell all the way down to where that true value point is at lower levels. Okay, and the opposite is also true. So if a fundamental analyst believes that this currency pair is underpriced and that the true value is way up at these levels right here, the fundamental analyst will buy, expecting price to reach its true market value up here. Okay, and the way that the fundamental analyst derives this outcome is by using economic indicators like interest rate changes, inflation rates, and so on, and moreover, even political factors like wars and presidential elections, and so on. Okay, so for example, if a fundamental analyst believes that because of an interest rate change in the US dollar, this dollar CAD currency pair's true value is at lower levels right here, and since current price is at higher levels, this will be a great opportunity for a fundamental analyst to sell all the way down to the true market value price level right here. All right, so now let me give you my take on technical analysis. Okay, so when it comes to technical analysis, the basic philosophy, in my opinion, states that future price is the result of past price. So past price will be in all these areas right here. And moreover, the pure technical analyst believes that all information that has the possibility to affect price movement can be understood strictly by past price. Okay, and the way that they analyze this past price is through statistic indicators. So let me go ahead and show you what that's about. Okay, so on this bottom end right here, we have the MACD indicator. Now the MACD indicator basically tells you when a currency pair is overbought or oversold. So in other words, this indicator statistically calculates when a currency pair is oversold. So when price reaches these bottom outer levels right here, statistically speaking, price should rise, and thus a trader should buy. Okay, so that will equate to this area right here. All right, and the same is also true for this upper end right here. So price reached this upper boundary, statistically stating that this currency pair is overbought, and thus the technical analyst will sell right at these levels right here. Okay, and moreover, they use statistical deviations to analyze past price. So if you look at these three lines right here, now this is the Bollinger Band indicator, and this indicator uses the mean price of a preset amount of past price and visually represents it with this middle line right here. Okay, so this is the mean price. And going from statistics, price should not deviate from its mean price, with the outer limits being this outer band right here and this band up here. And so the technical analyst will use these outer bands for opportunities to buy or perhaps even sell right back to its mean price right here. Okay, and moreover, technical analysts also use trend lines and price patterns. Okay, so a trend line will be, for example, from this pivot to this pivot right here. And moreover, a price pattern will be this double bottom right here. Okay, and the way that the trend line is used by the technical analyst also uses past price and is statistically driven. So in other words, according to past price, when price makes these kind of double bottoms right here, price will bounce up at least to its target height level, which is roughly in these areas right here. And the same is true with this trend line, is that if past price keeps respecting this trend line, the next time that price comes back up to this trend line, a technical analyst would sell, expecting that statistically, every time price reaches this trend line, price tends to bounce right off it and go down. Okay, so the key thing to remember is that fundamental analysis and technical analysis both have the basic philosophy that future price is predictable, right? Because a fundamental analyst believes that if the true market value of this currency pair is at higher levels right here, price in the future should eventually go up to reach that fair value price level. Okay, and moreover, technical analysts also believe that past price can foretell the direction of future price. Okay, so you want to keep in mind that the basic philosophy of fundamental and technical analysis is that future price is predictable. Okay, so now let's go on to price action analysis. Okay, so the basic philosophy of price action analysis states that future price is undetermined, and thus it's undeterminable, and thus future price is completely random. Okay, and that's the major difference between fundamental and technical analysts compared to price action trading, right? Because fundamental and technical analysis, at the core of their philosophy, believes that future price is determined to a degree, while price action trading believes that future price is undetermined and thus undeterminable. All right, so the price action trader strives to analyze current price and more or less maneuvers along with how current price moves. And so, for example, if current price right here tells the price action analyst that price will go up, in that case, the price action trader will buy. And let's say price does go up. At this point right here, let's say still current price is telling the price action trader that price will continue up, and thus the price action trader maintains their buy position all the way up to these levels. And for instance, let's say at this point right here, current price tells the price action trader that price will go down. And so at this point, the price action trader will close their buy position. Okay, so just remember, the price action trader strives to read current price and more or less maneuvers along with current price as each new price data is released. Okay, so let me just zoom out real quick. Okay, and the way that the price action trader analyzes price is through trend lines. So for example, from this pivot to this pivot right here. And let's say price reaches this trend line area right here. Now to the price action trader, just because price reaches a trend line does not tell them that price will go down. For again, future price is unpredictable, and instead watches how current price reacts at this level to make a decision whether price will go up or down. Okay, so again, current price is the most valuable in terms of the analysis to the price action trader. And moreover, we use price patterns also. So let's say this double bottom again. So at the moment where this double bottom forms, the price action trader will watch what happens to that current price at that point when it forms. And if price says that it's going to go up, in that case, they will enter a buy position. However, if at this point, even if there was a double bottom formation, if current price is telling them that price will not go up, in that case, the price action trader will not take a buy position. Okay, and moreover, the price action trader also analyzes price through price fluctuations. So for example, if you have a candle of any time period, the speed in which price fluctuates on any given candle gives the price action trader the knowledge of what price may do on its next step. And moreover, they look at long-term fluctuations of price. So for example, if this is point A and point B, to the price action trader, what's important is not the fact that price traveled from A to B, but it's how it got there. And so in other words, how price travels from A to B is another way that the price action analyst analyzes price. Okay, so now that we know the basic concept of each major type of analysis style, let's take a look into strategies. Okay, so strategies. Now, regardless of any type of method of analysis that you choose, a strategy is going to have 4 components to it. Now, one is the bias identifier and the entry strategy, the stop loss and target strategy, and trade management. All right, so let me explain what each of these components are. All right, this is the pound dollar monthly chart. So the bias identifier is what tells you what the overarching bias of a currency pair is. Now by overarching, I mean the long-term bias. All right, so if we take 2015's price right here, and current price right here, the overarching bias or the overarching trend of this pair, I would say, is down. Now, I just eyeballed this chart and said that bias was down. However, the bias identifier is going to be a component of a strategy that systematically tells you what the long-term bias or long-term trend is, whether long or short. Okay, and I'm going to get into more depth with each of these components later. But for right now, I just want you to get the basic picture of each component. Okay, so next is the entry method. Okay, so since the bias identifier is telling us that the overarching bias or trend is down, at the basic level, we do want to enter trades in the same direction, which is down also. So the entry component of your strategy is what's going to systematically tell you when to enter that sell position. Is it now? Or is it after price comes back a little bit? Or perhaps only if price reaches a certain level on the downside? Okay, so the entry strategy is what tells you systematically when to enter a trade in the direction of the overarching bias. Okay, and then we have the stop loss and target strategy. So let's say we entered a short trade at the current price level right here. Now at this point, we also want to know how much are we willing to risk and how much reward potential is there. So the stop loss portion is what dictates systematically what your risk will be. So for example, let's say the stop loss strategy states that if price reaches this price level right here, you would abort this sell position. Okay, and the target strategy is what tells you at which point you will take out your position. So let's say we took a sell position right here with a stop loss at this price level right here, and price does begin to fall all the way down. The question becomes, at what point are you going to take out this position? Is it at this level, or is it way below? Okay, so the stop loss and target strategy defines your risk and reward, but only at a price basis. So in other words, the stop loss and target strategy tells you what your risk and reward is in terms of price levels. Okay, and finally we have trade management. So again, let's say we entered a sell position right here with a stop loss at this pivot high and its target at this pivot low right here. Now trade management is what's going to tell you, first of all, the monetary value of your risk and reward. So how much in monetary terms are you willing to risk? And moreover, how much you are attempting to profit with the reward. But more than that, trade management is the component of a strategy that tells you whether or not you should abort a trade. So for example, if price was coming down to these levels right here, and if certain things happen at these levels right here before the main target right here, your trade management rules are what's going to tell you if you should take some profits out early or perhaps extend it down to its main target right here. Okay, and again, I'll get into more detail with all these components in the latter part of this course. So let me just sum this up on that slide. Okay, so what you want to remember is that the basic construct of a trading method is first your method of analysis, and depending on which method you use. Now again, that could be a hybrid, so you could use fundamental as well as technical, or you could be a pure price action trader. But either way, your method of analysis is what's going to provide the tools for your strategy. And the four components of a strategy is a bias identifier, entry strategy, stop loss and target strategy, and trade management. And the method of the analysis that you choose is what's going to provide the tools that will create your strategy, which is all these four components down here. All right, so now let's go ahead and look at some possible trading styles. Okay, so trading method examples. Now let's take Emma right here. Now Emma uses technical analysis as well as price action analysis. Now in terms of technical analysis, she uses Bollinger Bands and moving averages, both of which are technical indicators. Now on the price action end, she uses price patterns. Okay, and her strategy is going to be made up of these three tools of analysis. So in other words, the four components of a strategy are going to be made by these three tools. Okay, and then we have Brad right here. Now, Brad is a fundamental analyst and moreover a technical analyst. Okay, so on the fundamental side, he uses economic reports and moreover balance sheets. So in terms of Forex trading, he will look at government balance sheets to analyze the fair value of a currency pair. And moreover, on the technical end, he uses the RSI indicator and moreover the moving average indicator. Now again, his strategy is going to be made up by these analysis tools. Okay, so one thing to remember is that even if the basic philosophy of each of these methods of analysis are different, it's quite possible to still make a strategy that includes different philosophical schools of thought. All right, and then we have Lisa right here. Now she's a purist, and she only uses price action as her method of analysis. So in her case, she uses candlestick patterns, trend lines, and price patterns. And so her strategy is going to be made up of these tools that will furthermore provide as the tools for the four components of her strategy. Now, regardless of which method of analysis you choose, whether it be hybrids or purists, each one of these strategies is going to have to go through a process of making that strategy more efficient in order to reach our main goal of consistent profits over the long term. So let me show you what it means to develop or hone a strategy until it reaches efficiency. So let's go on to the next slide. Okay, so a profitable strategy process. Okay, so at the very beginning is going to be the creation. So you're going to pick your method of analysis, pick your tools, and create the four components of a strategy. And when that's done, you're going to go into the back testing phase. So you're going to take that strategy that you have created and test it in the markets to have an understanding of whether or not you should even continue on to the next stage, which is refinement. Okay, so let's say you back tested your strategy and you thought it's worthwhile. Well, then you'll go on to the refining phase. Now, this is probably the longest phase in terms of time in this entire process. Now, this is where you begin to hone or refine your strategy to reach relative efficiency. Okay, so at the top of the list right here is efficiency. So this is our goal. Now, there's two types of efficiency. There's relative efficiency and there's efficiency. So relative efficiency will be our first goal. Now, that's to at least break even month over month over the long term. Okay, so your profit and loss is at zero over the long term. And as you progress, further refining your strategy, we want to reach the efficiency phase, which at this point is constant increased profits over the long term. All right, so let me explain to you why reaching this point of efficiency is so crucial in terms of trading. All right, so total profit equals strategy efficiency. Okay, so this upper trend, we have total profit, which is consistently increasing over the long term. And on the bottom trend right here, we have strategy efficiency. Now, the key thing you want to remember is that if you want to reach our main trading goal of increased profits over the long term, you want to remember that the trend for total profit and the trend of strategy efficiency should be identical. All right, so from the age of 25 all the way to about 28, there was increased profits. However, there was a slight drawdown right here, where your strategy's efficiency should also have a drawdown also. Okay, and moreover, from age 28 all the way to about 33, we have increased profits, and your strategy efficiency trend line should mimic your total profit. Okay, and this relationship of total profit equals strategy efficiency will continue throughout your trading career. Okay, so now let's take a more in-detail look of how a trader would reach strategy efficiency. All right, so a profitable trader's timeline. So in the beginning of trading, there's the creation phase. Okay, and during the creation phase, you want to use historical data. So in other words, you do not want to be using real-time data just for the purposes of saving time. For if you were creating a real-time data, you're going to have to wait for each daily candle to form. Okay, and relatively speaking, the creation phase is much smaller compared to the other phases shown here. Okay, so after you've chosen your method of analysis and moreover created the 4 components of your strategy using historical data, you want to then go on to the backtesting phase. Now again, you want to use historical data just to save time. Okay, and this is where you test the strategy that you have created to see if it's even worthwhile to begin its refining phase. Okay, so let's say your strategy was a success and you decide to begin refining it. Okay, so that's the refining phase. Now during this initial refining phase, you have a choice of whether using a real account or a demo account. Now a demo account is not going to use real money. However, on the other hand, you could also use a real account with mini lots. Okay, so what I mean by mini lots is that the amount you trade that can be decreased to the point in which it will not affect your wallet. Okay, and some providers actually have nano lots, which are very incremental in size. All right, and so whether you're going to choose a real trading account with minimal lot sizes or use a demo account which has no monetary risk, you want to expect negative profits at this point. Okay, so you want to know that if you're going to choose a real account, just know that in the long term, you will not be making money at this initial phase of refinement. However, in terms of motivation and other emotional reasonings, I think either one will do. But just make sure you're using substantially lower lot sizes, for you will be experiencing negative profits in this phase. Okay, so this initial refinement phase is going to be the longest in terms of time. And how long this phase will take really depends on multiple factors, such as pure talent and how much free time you have to use on this refinement. Okay, but just remember, this is the longest phase in terms of refinement. Okay, so after you completed this section of the timeline, you're going to go on to step 2 of the refinement phase. Now at this point, you'll be experiencing break-even profits and losses month over month. So although you're not making money month over month, you're also not losing money. Now this point I call relative efficiency. Now a major thing you want to keep in mind is that reaching relative efficiency is a huge accomplishment in itself, and not many traders can reach this plateau. Now that's because it's over the long term, as it says right here, month over month. Okay, and at this point, you want to begin increasing your account size. Now right here I wrote normal. However, this is going to depend on your financial situation. But the point is, you want to begin to increase your lot sizes. Now the reason why you want to increase your monetary lot sizes is because, first of all, at this point, you're skilled enough as a trader to reach relative efficiency, so there is no major risk of monetary loss. But moreover, in order to reach efficiency where you can increase profits month over month, there is the mental aspect of your trading that you must begin to hone also. So in other words, it's much easier to make trading decisions with fake money than real money. Okay, and in terms of the time it will take to finish this second refinement phase is case by case. However, one thing I can say is that I'm sure it will be less than the initial refining phase right here. All right, and then we reach efficiency. So that's when we begin to experience an increase in profits month over month. Now at this point, you do want to begin to increase the lot sizes of your real account. Now the reasoning for this is the same as the previous stage right here, where you're going to notice a Goldilocks point in terms of how much you're comfortable in terms of trading, of course in monetary terms, and pushing ahead and increasing lot sizes before you're mentally and technically ready for it is a common mistake that I myself continually make to this day. Okay, but that said, you do want to keep increasing the lot sizes after you reach the efficiency phase in order to find that Goldilocks point where your skill, where your technique and your mentality is in balance with how much monetary risk you take. Okay, and moreover, you want to remember, even after you reach efficiency, the refining of your strategy will never end. So as you guys know, if you watch my forecast, there's times when I still refine my strategy because I find new ways to further increase its efficiency. Okay, so the refining of a strategy is something you will do throughout your entire trading career. Okay, so regardless of the method of analysis you use, this is the basic profitable trader's timeline that you will likely experience. Now that said, I am a price action trader and this course is based on price action. So let me go ahead and show you why I believe pure price action analysis is the fastest way to get through this timeline to efficiency. Okay, so price action analysis is ideal for honing a strategy to efficiency. Now let me explain. So price action trading, its essence and its main attribute in terms of honing a strategy to efficiency is that it does not use any analysis tools in which its legitimacy can be questioned. Okay, so if you think about fundamental analysis and economic indicators, we don't know how they gather that information. And moreover, we do not know the formula in which they produce the results with that unknown information. So in other words, the legitimacy of the result can be questioned. And that's the same for technical indicators. So a technical indicator uses a statistic formula to derive its result, but we do not know what that formula is. I mean, I'm sure you can know to a degree, but if you're not the creator of it, I'm sure there will be questions in time. Okay, but when it comes to price action trading, we do not use any analysis tools in which its legitimacy can be questioned. So for example, that's candlesticks, trend lines, price patterns, and price fluctuations, all in which the results and final outcome cannot be questioned because the analysis tools in themselves do not rely on others' ideas in order for them to work. Okay, so in other words, candlestick patterns, trend lines, price patterns, and price fluctuations have zero unknown variables. Okay, and when it comes to that main goal of trading of consistent profits over the long term, in terms of how fast we get to efficiency, not having any tools in which its legitimacy can be questioned will save you a tremendous amount of time. Now just imagine as you are honing your strategy, which means you're getting in more detail with your strategy and you don't know how your analysis tool operates at the base level, that's going to cause a lot of confusion because you wouldn't know where to look for the problem. And moreover, even if you were to find out the nuts and bolts of how your analysis tools work, in my opinion, it's next to impossible to truly know how something works if you did not create it. Okay, so in terms of how long it takes to reach efficiency with your strategy, price action trading is truly the ideal style of analysis to get you to that plateau in the fastest way possible. All right, so let me go ahead and explain to you the basics or the essence of what price action analysis is. Okay, so price action analysis explanation, learning how to read price. So you want to remember in price action trading, at the very core, we're learning how to read price. So in other words, we're letting price tell us which way it's going to go in the next step. Okay, so for example, when a person learns to read a new language, okay, first they're going to need to learn the basics. So that's vocabulary. Then they go on to grammar. And then they go into more complex sentence structure. Now, this general knowledge is what allows them to read in a new language and thus derive an idea from that text. Now, in the same way, a trader first learns the basic vocabulary, grammar, and sentence structure, which will equate to candlesticks, trend lines, and price patterns that will give them the ability to read price and thus derive an idea. And in this case, that would be to derive whether price will be going up or down in the next step. Okay, and I'll get into more detail about this during this course. However, just remember that price action analysis at its essence is about learning how to read price. Okay. Okay, and moreover, another core essence of price action trading is that we're always analyzing in terms of future strength. Okay, so we're going to use candlesticks, price patterns, and trend lines to read a currency pair's price in order to know how much future strength there is, long or short. Okay, so we're always thinking in terms of future strength. What is price telling us in terms of the future strength of the longs and the shorts? And we're going to derive that information by using candlesticks, price patterns, and trend lines to read the message that a currency pair's price is telling us. All right. So finally, here's a course overview. Now, in the beginning section of this course, I'll be going over how to read price using basic analysis tools like candlesticks, trend lines, price patterns, etc. However, keep in mind that the explanation will be unique in approach, for it is how I use and view these tools. So I'm going to explain these basic analytic tools from my perspective. Now, one is because teaching the common knowledge of these analytic tools have no value, because you could learn that from any book on trading. But moreover, I want to give you my unique approach on how I use these analytic tools, because how I view them has changed over years of experience of using them. So I believe that could save you a tremendous amount of time, for you could use my experience to your advantage and apply it to your trading strategy. And now moreover, I'll only be explaining only what I use and not the entire spectrum of traditional ideas. For I believe the majority are not necessary to trade effectively, and it's important to become a specialist of one or two tools rather than mediocre at many. Okay, so when it comes to these basic analytic tools like candlesticks, trend lines, and price patterns, to be honest, I do not use the majority of traditional ways of using them to analyze price. So instead of me explaining to you the entire spectrum of how to use these tools, although I don't really use them in real trading, I find meaningless. So I'll only be explaining the aspects of these basic analytic tools that I find to be effective. Okay, and after we're done with that, I'm going to provide a full price action strategy that you can begin to develop and hone. So that's going to include the bias identifier, the entry strategy, the stop loss and target strategy, and trade management also. Now I'm going to provide this full price action strategy that you can begin to develop, because I find that a lot of times most traders actually overlook the first step, which is the creation of a strategy. All right, so just to make sure that you don't miss that first step, I'm going to provide a full price action strategy so you can begin backtesting and perhaps even refine them to efficiency. Okay, and lastly, just as a note, in this course, I'll be providing the information necessary so the novice trader can smoothly transition to part 2 of this course. So whether or not you already digested the content of part 2 of this course, this beginner's course will give you the information necessary to further understand in more detail part 2 of this course. And then finally, just remember that this is a novice trader's course. So what I mean by a novice trader or beginner trader is that they do have some experience in trading. For example, 3 months to 6 months in trading. And this course is not designed for the complete beginner that has never traded before. Great job for making it this far, guys. Now here's the key takeaways from this lesson. Okay, so number 1 is that the main goal in trading is to make money consistently and over the long term. I just want to write this down and put it on a wall where you can see it all the time, because everything in the world is going to tell you the opposite. You know, they're going to talk about the now, so it's all about making money now and forget about the future. We'll worry about it when we get there. Okay, so please remember that your main goal in trading is to make money consistently and over the long term. Okay, and number 2 is that reaching efficiency with this strategy is going to take time. Okay, no one's expecting you to make a strategy in a year or so. Okay, so your job as a trader in the initial stages is to be diligent and patient and gradually hone your strategy to efficiency. Okay, number 3 is that price action trading's core philosophy believes that future price is undetermined. Now always remember this core philosophy, because the core philosophy is what's going to dictate the evolution of your strategy. Okay, so thanks for watching, guys. and I'll see you guys in lesson 2. Goodbye.